Hi, everyone, and welcome back to Stephan Livera podcast, brought to you by Bold. American listeners, you can buy and sell Bitcoin over at getbold.io. Now, joining me on the show today is CEO and co-founder of Onramp, and Michael is also the founder and partner of Early Riders. Michael, welcome to the show.
As we talked about before the pod started, I've been a long time listener. I think we referenced dating back to 2018 when it was, I think, maybe only you and TFTC as the Bitcoin only, maybe a few others, but I think those were the biggest ones. So appreciate you having me on.
Hey, well, yeah, thanks for joining me. And I know there's a lot of things going on in the industry. I know you guys are busy over there on the on-ramp side as well as the early riders side. I guess let's just start with a bit of a broader, where do you see things nowadays in the Bitcoin ecosystem? You know, is everybody onboarding through ETFs and treasury companies, and have they forgotten about the self-custody message? What do you think?
Yeah, I think the big thing, and I kind of feel a little naive that I forgot about this because I've been thinking deeply about the treasury company stuff and like what's happening there. And I think ultimately we forgot as Bitcoiners how hard it is for somebody to wrap their heads around not buying a little Bitcoin. It's easy to buy $10 worth or to buy, $1,000 worth, but really putting material wealth and thinking
Yeah.
about private keys, counterparty risk, the notion of what's happened the past 5 years when we think about the FTX debacles and the like. And ultimately, this is where the ETF saw a lot of success. And you have the CIO that was recently on a Blockworks pod referencing this. She knew that Bitcoin doesn't really require a wrapper around it, but the demand was there because at the institutional level and high net worth, they just didn't feel comfortable. They wanted like a stamp of approval. And then similarly, I think that's where the treasury demand also comes because when you think about most individuals, and I've never been in this camp, I've had to learn all this, but most individuals have a traditional 60/40 portfolio and their mental models are wrapped around, generally public equities, sometimes private investments. And it's a lot easier for them to wrap a thesis around a public equity that has some proxy exposure to BTC versus how do you actually secure this alien technology? And I felt a little weird because, we've just been looking at this stuff for a while. It's like, it's not that hard. You can go buy it. You can go buy a hardware wallet. You can write down 12 words. You can leverage collaborative custody. You can even use something like multi-institution custody. But at the end of the day, there's still a clunky process when it comes from moving assets out of a trusted bank account into a third party place. And the way I think about it is like gambling, right? Like if anybody ever gambles, you go to like a Bovada or these like third party sites, and they're kind of like you feel a little icky and weird because it's not a trusted source, and that still historically is what has existed in the space, not a like global or consumer friendly brand outside of like the Fidelities and BlackRocks of the world.
Yeah, and I think the other component of it is it just takes time for people to be comfortable with these things, right? Like if more fiat or no coiner minded people are just thinking, well, I know this bank because it's been around for 100 years or whatever. Bitcoin's only been around for 16 years, and the large players in this space have not been around that long comparatively, right? Even like a Coinbase, when did they start? Like, I don't know, 2013 or 14 was when they really started to become prominent. Maybe they started in 2012, but in terms of like actually being prominent, that's about when. And Coinbase is seen as like, okay, they just recently entered the S&P 500, so they're kind of one of the big players. But of course, there are so many other places to be buying Bitcoin, doing or custodying Bitcoin and learning about Bitcoin, all these things. So I think it is just a time thing as well. But at the same time, there are, I guess, kind of getting into the custody conversation. I think if I sort of look back over the years, there was this demand of, oh, it needs to be a qualified custodian. It needs X, Y, and Z. So how are you thinking about that? And how are you then marrying, what you're providing on the on-ramp side to, those end customers who, they want to tick these boxes?
Yeah, so I think going back to what you referenced, I think there's a thing we conflate, and I don't know how to describe this. I got lucky that we can talk about OnRamp and how we came about. I was in the middle of the soup or the like proverbial soup where I thought like not your keys, not your coins, no matter what, we're going to go into, the future. And that's the only thing that will ever exist. And so when we launched OnRamp, it was a different vision. It still had multi-institution baked in, but this stuff that we'll share today has kind of been revealed over the course of being in one world and also having to migrate to another world, which is meeting the market where it's at. The joke that I like to share is that we as Bitcoiners want to be right. There's two versions. Do you want to be right or do you want to make money? And being right is that we're all going to be self-sovereign and, hold our keys with our guns and our citadels. But the reality is like, it didn't work for gold. Even though gold and Bitcoin obviously are different, they're still very similar in the sense you could take delivery of a large percentage of that. But somebody bigger will always show up for that. And so you still need to work with like trusted intermediaries. You just want to work in a trustless fashion. And so this bakes into just the key notion you mentioned earlier about getting exposure. It's super easy for us to understand how to write 12 words down or 24 words. It's insanely hard for somebody to put material wealth in 12 or 24 words. That's the big gap that for some reason we can't like articulate well or feel. Like we know it's pretty easy to put a fast phrase, but try telling somebody that's a billionaire or just used to working all day long, because there's a lot of confidence and education that took us to get there. The other side ties to the trust and custodians, that Coinbase is like an anomaly. I think everyone listening here knows the existential threat or the threat that it faces, or that it poses to Bitcoin in the sense of centralization of the asset. It's actually the reason why Onramp truly exists or was created. But at the end of the day, like the mental model I use when we talk with institutions or folks that are trusting of third parties is at the end of the day, if you put on a wall all the custodians that have existed for the past 15 years and you just put a blindfold on and threw a dart, you would hit a custodian that went belly up, like that's out of business. And so that's ultimately where self-custody has been this mantra and been the best, most sophisticated way because you needed to sever that internet connection. And so that's part of my background was, again, following you and Marty and learning from back in the day that I needed to get my assets off of Gemini. And it led me to developing a relationship because I was a native Texan with Parker, Lewis, who became a good friend. I joined on chain. I was one of the first clients as they were pivoting from the lending product into the custody product, and then joined their firm. I was probably number 6 or 7 employees. So built that business from the ground up. And to your point, what I learned was after onboarding thousands of people and billions of dollars, it was actually less about what I've stumbled onto now with OnRamp. It was more of like businesses just would want to adopt. They'd get individuals like me or you. Imagine we work at companies and we want a position. We say self-custody is the way, collaborative custody, seeds, wallet config file. They were on board, but they went to their board and their board laughed them out of the room. So we need to either never talk to them or they'd come back with their tails tucked between their leg. And it was kind of just like an eye-opening moment. And then when you take that up a notch, once you get to people managing external capital, so fiduciaries, whether it's corporate treasury at the public listed level, endowments, pensions, just any institutional capital cannot manage their hardware devices. You hear a lot of self-custody proponents will talk about we need to get them set up. They just can't. It's not like structurally feasible when you think about the churn of an organization, burning those keys and all the things associated, let alone the technical competence to manage that. And this notion of, well, you do want decentralization of the custody, but if you can reduce the friction of onboarding and going through all that process, and that's where multi-institution effectively came about. I'll pause there because there's some other things to share on like where it really ties into the individual, but want to
Yeah,
kind of
of
give you
course.
some room.
Yeah, no, and I think you make some interesting points. I think it's worthwhile people hearing those points because, of course, at the individual level, and of course, if you can self-custody, I recommend you do that. But I think I guess the steel man would be in some of these cases, particularly in the, let's say, public company case, or particularly in the, as you mentioned, fiduciary cases, or in cases where, some people are holding for other people, then it's a tough conversation to say C-level executives and maybe a board member should hold the keys, right? Because then it's sort of like, are they actually the owners of those coins if they are holding them on behalf of actually the shareholders of that company, as an example?
Yeah, because it's not their money, so it gets to be. There's a lot of other factors that come into play. I think going back to where you were referencing, so because I think this is important, like for listeners and just to discuss, is in 2022, it was a big learning, eye-opening point for me personally because all the individuals that you thought knew what they were doing and were the rainmakers had no idea what they're doing. I think we all know this when you think about Celsius FTX, but even the Geminis of the world that put their clients in Earn product or the Grayscales. And it was eye-opening because, well, had questions about the business model of, collaborative custody. And ultimately, if you push all of the responsibility to the end client, how much can you really charge for that? That's just a longer term question around just collaborative custody models. But I did see how we did everything right, meaning we never lost clients' assets. We took care of them. We were fiduciaries of that wealth, meaning we helped them educate about how do you lend against it? How do you think about conservative solutions? And so I knew we did the right thing. And I looked at the market, and to your point around centralized custody was like, wow, because we have this slide and you can find it in our deck and can share it in the show notes if important, but it's ultimately looking at self-custody and third-party custody. And we would used to use like collaborative custody in the middle. And I was a little naive thinking this is the perfect middle ground. You still retain sovereign, have support. But as I like took a step back, I learned that that was more in the self-custody camp. And the ultimate notion was that all this capital that's coming in today, back in 2022, I think we all knew the trillions have to come in. It's like, holy crap, it's not going to come into self-custody, no matter if we want to or not. Tens and hundreds of trillions of dollars are not going to be held on hardware devices, and they're not going to be held in self-custody formats. And so the alternative is it's going to be held with centralized institutions. And anybody that's underwritten Bitcoin's value prop has had to look at gold and how did gold fail? It's centralized. And so I just looked at that. I was like, this is actually existential and independent of us at Onramp being successful. I was like, we need to get this model into the world because it's kind of like 0 to 1 when you think about. I'll argue that the difference between gold and Bitcoin is literally that you can insert technical governance into the underlying because it can scale proportionally, whether it's 3 institutions, 5, 10, and that's fundamentally different than what happened with gold, and that's where gold failed. And so that's where we launched was with the OnRamp Bitcoin Trust. It wasn't even about a custody solution. It was literally how do we build, I looked at Grayscale and I saw Grayscale had 600,000 Bitcoin and they were printing 10,000 Bitcoin a year. And so they objectively had product market fit, right? They were giving people exposure to the best performing asset of all time. They also objectively had a horrible product, right? They had 3 layers of counterparty risk with Coinbase, Grayscale, and then the intermediary issuer. They cut Bitcoin's kneecaps in half at you couldn't take delivery of the underlying. And then they didn't focus on education and Bitcoin only specifics, which is very important, not even from an ideological perspective, from a business perspective, because most individuals, all the way to institutions, end up at exit liquidity when they come into the space. They don't have anybody telling them what they're buying. They're buying the meme. That's what the ETF is. It might as well be for a lot of people. They're buying the meme. And when the price inevitably gets volatile because of leverage and all the animal spirits we know are coming, well, then nobody's there to tell them it wasn't Bitcoin that's retracing. It's not Bitcoin's fault. They should be double downing and buying more. And so that's how OnRamp launched. But then from OGs all the way to net new holders in 22 when we launched, wanted demand for the custody solution. And so rather than park it in the fund, we're the fiduciary, we said, hey, like, let's hold on a second. Let's actually go do this the right way, where you're the title owner of the Bitcoin, you direct all the keys legally. And so that's really what has turned into what we'll talk about today, and how I'll make the case, and I'd love for you to push back, where I'll make the case almost all individuals will use some form of multi-institution custody for some component of their assets. And the main reason why is because you can have the most bulletproof, battle-tested self-custody setup, but there's still 1% chance that it goes wrong. And that 1% should go into multi-institution for God forbid something happens, your family can still like recover it. And that's not even accounting for all the bad actors and bad attacks that are coming at $500,000 Bitcoin. But that's a topic for a different day.
Yeah. All right. So let me steel man for a second. Let's say, look at the new Miniscript stuff. You can do, 2 of 3 multisig, and you can have like some kind of emergency key that's only valid 1 year from now, 5 years from now, 10 years from now, this kind of thing. And you could sort of say, okay, you're going to do your 2 or 3 multisig or your 3 or 5 multisig as your main standard setup. And then you have this emergency key that's at the protocol level. And therefore we don't need, let's say a direct custodian. You only need somebody who can be like that emergency key. What do you think about that?
Yeah, so I think there's a component of going back to even just giving the credit, which I can argue against it, but let's say Miniscript is a better technology. The better technology doesn't win. Like we can go to Tor browsers or other things, the most commercial technologies that are easy to understand. And so I do think Miniscript and time locks are going to have a big function, but like I've been building for about 5 years, specific Bitcoin custody, thousands of clients, billions of dollars. Like we're at the edges when I think about multi-sig and multi-institution. The second you layer in complexity like this, and all Miniscript instances that I know of are all proprietary, which most people would use that as a positive, saying, oh, we own our own tech. It's like, that's actually very much a negative when you think about the custody of somebody's wealth, because you can't audit it. Multi-sig, the beauty of that is it's interoperable. And here's the keyword, battle tested. So multi-sig has existed since 2013. It's on the base level. It's been used since then. So the mental model for listeners and even for yourself is think about how far it took collaborative custody and CASA to really pick up mainstream. Like those products came about in like 16, 17, and their inflection point, because I've been in the middle of it, wasn't really until 2021 where we went from zero to, hundreds of millions and then billions in AUM. So that's the idea with Miniscript. Now go tell somebody you're going to time lock your assets and do this. And if you mess up, good luck in giving your money back. It's just not like commercially viable for the vast majority of people, for better or worse. Again, I know this isn't what a lot of people want to hear, but it goes back to this is where all the money is going to be made in the future world, is bridging on-chain, like battle tested, trustless ethos mixed with what will just the rest of the normies go accept. Nobody cares how the browser works. They just click the button and it works for them. And that's where all the money's made.
Interesting. And so I mean, and I don't want to be like a hypocrite here, because at the same time, many people, even many listeners, they started with a custodial exchange. It's not, because sometimes there's kind of this online sort of persona of like the perfect person who, no KYC, everything peer-to-peer, everything full node from day one, multisig and off, air-gapped, and, every little perfect thing. But the reality is many people start custodial. And now many people are starting not just custodial, but in some kind of derivative thing, whether that's Bitcoin Treasury companies or ETFs. And then maybe they start thinking, oh, wait, actually, I need to learn a bit about this self-custody thing. Okay, now, and then now you're going down that journey. So don't want to be a hypocrite. I understand people will onboard how they onboard, and there'll be different trust models for different things. As an example, there'll be some users who use a custodial Lightning wallet or whatever. And of course, I would wish everyone used self-custody, but we know that's just not the reality today. So understanding that, it's about how do you kind of give people options and then sort of give them a pathway to be able to self-custody if they choose. I think that's kind of where we're at least personally. I've sort of, while I encourage people to self-custody, I'm also kind of resigned to the fact that at least today, given current technology, we're not going to get 8 billion people and 300 million companies self-custodying on chain. Like, it's just not, if you just look at the numbers, it's just not happening, right? So it necessitates some form of custodial thing. And then in the world of custodial things, what is, a better trade-off?
Yeah, it's 100% right. I think that there's so many factors that go into this. There's not a one like reasoning point or decision. I like to go, and I had this discussion with Bob Burnett from Barefoot. I think he's fantastic and deeply understands the technical components of like the scalability as you're referencing. But there's actually, in my opinion, more important, there's a socioeconomic perspective of the aspect. Like, even if we could, from a UTXO perspective, hold all our Bitcoin, that's not what people want to do. Like, for better or worse, not everyone wants to be their own bank. And this is where I think we have to go back in history and understand the reason why banks existed and depositories existed is because bigger people come up and show up if you own all your money or you can control it all. And so there's a natural like friction you want to put in between. So like the way I'll anchor it is I've gone through Gemini, self-custody, collaborative custody, and then ultimately realized the barbell approach is right for me and a lot of our clients, where I have a nice stack. In as much as, MVK kind of, I think we joke and we talk, we say it's hardware devices, it's fun to play and call them plastic devices, because that's really where people are securing. Today, it's $1.4 trillion in capital. That's the thing nobody talks about, is 70% of all the assets sit offline, because that's what you needed to do to secure this digital bearer asset. But I love like my queue, and I have multiple hardware devices running a backup. So to give a shout out to even Zach, because I have a passport set up clone with a passphrase and a seed that, is ready to rock and roll if I need to get out of town. But that's not for all my wealth. It increasingly won't make sense for that to be all your wealth, because what happens if you get hit by a bus? What happens, if your brain stops working right? You can have different steps in place, but you always have that, like, at the end of the day, it's a lack of peace of mind that a lot of people are starting to feel as their wealth appreciates. And that's really why our clients come to us, is to diversify that risk. And that's different for everyone. And I think that's the core component. It's like, there's no perfect solution. There's just perfect trade-offs. And we've had so much time in the market to talk through and think about this stuff that we kind of see, like, it's our job to see ahead of it. And the case I'll make is at 150 and 250 and 500K, all the things we're talking about here will make so much sense to people. And it kind of has to, because if you think about it, this device has secured, it does still secure the vast majority, right? They still own the majority of the market share in the hardware wallet market, like 75 to 80%. So let's call it roughly $1 trillion sits on that device, and it's sat there since Bitcoin was like $10 to $50, all the way to now to 100,000. And nobody's talking about, well, what happens at 4K. And again, Miniscript, sure, it's going to make sense, but like 5 to 10 years from now, nobody's locking up real capital in Miniscript. People will talk about it. It's the cool thing to do in the Bitcoin space. Like, show me a serious person that's using it. It's not real money being stored there, at least today, and probably for the next couple of years.
The lead sponsor of this show is Bold, the best place to buy, sell, and save Bitcoin. For listeners in the US, Bold lets you secure your financial future with complete peace of mind by integrating a low-fee, Bitcoin-only brokerage with next-gen multi-sig vaults. With Bold, you can smash buy Bitcoin or set a DCA plan for only 0.99% fees and seamlessly deposit the Bitcoin direct to your Bold vault. The Bold Vault is a 2 or 3 collaborative multi-sig where you hold 2 keys and Bold holds 1 as a redundant backup, protecting against loss or theft. You can use Trezor, Ledger, or Coldcard hardware wallets to spin up a Bold Vault in just a few minutes, and the Bold Vault is the only collaborative custody vault available with 0 monthly fees. They're also offering 0 fees on your first $10,000 of Bitcoin buys and $25 of free Bitcoin when you buy $100 of Bitcoin or more. Try Bold today and upgrade your stacking experience over at getbold.io. And now, back to the show. Interesting. Yeah, I don't have stats on this, but just from what I've heard, I mean, I don't know. It could be that if you talk to, I don't know, Kevin from Liana or, some of the guys doing this Miniscript stuff, maybe they've got a few kind of whale or somewhat whale customers, but I don't know. I don't have the numbers, so I wouldn't be able to kind of push back on you there. But nevertheless, Miniscript may also be leveraged by custodians too, right? It's not something that's only used for the, the sovereign individual or the sovereign family or whatever. It's kind of like this technology is going to make it better for everybody. The other thing that I find interesting is stuff like, now again, this is maybe controversial, but things like op vault, or let's say kind of superseding that is this idea of CCV. So that could enable this kind of reactive security model that's even better than what the multi-sig we have today. Maybe someday, hypothetically, again, it's a maybe, we don't know. That could happen, I don't know, 5 years from now, 10 years from now. That could also change the game too. But to your point, it takes time to get comfortable. And multi-sig has been around. It is battle tested. And I think that's been the reality of where, serious money is stored. But actually, while we're on that, I want to get your thoughts on this as well, because basically that's been a big, let's say, Bitcoiner versus shitcoiner thing, where it's like a lot of the hardcore Bitcoiners, they love multi-sig, and then kind of shitcoin people and shitcoin exchanges and shitcoin custodians, they tend to often go for MPC, right? Because they want to be able to use the same secret across many different assets, whereas, because those assets don't have multi-sig natively on-chain, they've got to do some other approach. So how do you see that, multi-sig versus the MPC side of it?
Yeah, 100%. I mean, this is all, I appreciate bringing this up because this is all we talk about. And we're talking with like multi-trillion-dollar asset managers to hold keys in the multi-institution quorums, because that's ultimately where I see this all going from a pure game theory perspective of, you can imagine Coinbase, Fidelity, BNY Mellon hold a key, or let's take out Coinbase, Fidelity, BNY Mellon, and State Street. Well, why would anybody keep their assets at Coinbase? Like, it just doesn't make any sense if you can get knocked out of the game there, right? But to your point, sophisticated individuals grok what you said, but most of the market doesn't. And this kind of ties into the opportunity on the investment side, and what like we know, and for anybody listening that can build, is any sophisticated, truly sophisticated actor in Bitcoin that is dealing with altcoins, crypto, they segregate multi-sig native to the protocol for Bitcoin, and then they use MPC for their other assets. BitGo is a perfect example for this. But then when you look at other platforms, they will conflate, and I like to joke, they throw the baby out with the bathwater. And so they just put everything in the bucket of MPC because it's easier and to use MPC across all solutions. But the reality is it all goes back to one key. And here's the other part. So it's a single key, but just as importantly, it's all proprietary cryptography. It goes back to the Miniscript stuff. It's not that they're apples to apples, but it's the notion that when things are proprietary and are closed source, you always are going to be more careful on what it's used for. And so, like, I know your listeners will appreciate this, is like, if you go back to it's like the godfather of MPC, it's the CEO of Fireblocks. He worked for like Israeli defense, like basically like the CIA for Israeli defense. It's like, it's a very funny thing that they sit within all these banking systems. And so, and it's inherently fragile. So I'm glad you called that out, because it's an important function that even if you play with crypto, like you should make sure you segregate the assets when you think about your custodial relationships. And Bitcoin on-chain native multisig is auditable. And still, a lot of these institutions have no idea what we're talking about. If you go talk to a State Street, it's very few people that will have a familiarity or understanding of the difference.
Right, because in their mind, it's just kind of qualified custodian, SOC 2 compliance, tick tick. That's kind of, is that their mindset, or how are they thinking?
It's that, but it's also like I don't have the slide readily available, but when you look, and like Matt's done this before, not to call him out, but like he did it publicly, so that's where I'm referencing. It's like it's easy to conflate MPC and multisig because when you look at MPC, you're looking at a sharding of a key across multiple functions, and then you're basically splitting up the cryptography. So those shards have to come together, and it all reconstitutes to a single key. When you're thinking about multisig, multisig is multiple private keys and then derivation and XPubs tied to those private keys. And so you can shard the single key, and that can tie into like how multi-institution works. Is anybody that's doing institutional grade kind of custody is a different one-to-one factor. It's not like a hardware device and a seed phrase. They're basically having shards that comprise that single key. And so it's easy to conflate where you have three keys in multisig and then three shards in MPC. And that's how where people look and they're like, isn't that all the same? And I talked to somebody super senior at Coinbase. I was fascinated by what we're doing. And they're like, well, what's the difference between like, MPC, and you have to get in the weeds. It's so early. And the reason why everyone's missing this, everything we're talking about here, especially like what you said early, is that nobody has material wealth in Bitcoin. Like that's the big gap that I think both sides miss. The normie world and the TradFi world is just playing around. Like they're all short. Even these people on Twitter and that you go listen to that are all talking about corporate strategy, they all don't really have much Bitcoin. That's why they're going to end up losing a lot of their Bitcoin in the corporate strategy because they don't really, it's like a trader trying to make, more fiat with Bitcoin. They can't like actually model it out the correct way versus us like on the hardcore side have gotten it deeply for a long time. We're like, well, why can't anybody else see it? And there's just a gap because it all actually, in my opinion, stems back to how the hell do you custody this? Because most people, they don't know it's custody implicitly. It's that they're underwriting, oh, it ends up in a UK landfill or it ends up in North Koreans if I get any material exposure. So it must all be a Ponzi. And that's why I feel, so passionate about what we're building at Onramp and multi-institution custody, because I think it's the right ground for people to start where they can get material size and not have to be super educated on what's happening. Just know that it's resilient, redundant, and fault tolerant. And then to your point, if they want to go down the rabbit hole and self-custody, Miniscript, and all those things, like that's perfect for them. But it shouldn't be a barrier where somebody has to spend 6 months or 6 years to get to the point that most of your listeners are to preserve their wealth. And that's the catch 22 that everyone doesn't really grok. It's like by telling everyone to have fun staying poor, or you have to use a hardware device and write down 12 forwards, you're effectively telling people either A, not to buy Bitcoin or go into the ETF because again, do you want to make money or do you want to be right? And being right is the what we're talking about, but that's not how people like are approaching things, especially when it comes to their material wealth.
And I can appreciate the meet people where they're at aspect of this. Of course, we can talk about what's ideal, right? Multisig, and maybe in the future Miniscript, and maybe someday in the future some kind of advanced vault stuff that can handle all these things like the inheritance and all those aspects of it. But you have to meet people where they're at. And so look, let's get into a bit more of the detail around exactly multi-institution custody, exactly how it works. Now, I had to look through some of your deck and some of your stuff online. As I understand, it's a quorum of quorums. You're using multiple custodians, but each of those custodians are in turn using sharded key storage. So can you just explain a bit of that? Give us a bit of an overview for listeners who want to understand a little bit of the technical guts of this.
Yeah, for sure. It's something I'm insanely proud of, and our team is because historically, what took us 2 to 8 weeks to onboard somebody via collaborative custody, you got to ship the devices, onboard them, educate about wallet config files, and still a lot of people don't feel comfortable. While we saved a lot of assets, a lot of people never moved from BlockFi because you, at the end of the day, have to wrap your head around multisig, but also if you're doing it right, which most people aren't, they just have everything put underneath their desk drawer in collaborative custody or in some single point of failure. They don't know how to reconstitute the wallet, which is a big deal because God forbid, that's the reason why you're using it. If the third party goes down, how do you rebuild the wallet? And I'd make the case you need to be able to rebuild it multiple places because if Sparrow doesn't work for one day or they change the way that they construct the derivation paths and XPubs, you're kind of like SOL. So to your point on the technicals, it's kind of a technical feat. It's almost like magic, to be honest, when you work through it. because when you onboard, it takes what took 2 to 8 weeks, like 2 to 8 minutes, because it's really just the onboarding process. You are going through a unified experience on our website. I would encourage anybody that's interested to go through because there is a self onboarding now, but you're effectively filling out legal governance because that's what ties into the technical governance. So you get the best of both worlds is you have, your terms of service and your relationship with Onramp and how their keys used in the same way you onboard with BitGo, who has over $100 billion in assets, co-founder, CEO, invented Multisig, the first implementation, Mike Belshi. And then CoinCover is baked in as a recovery partner today. Now, this is easily modular. We have like another qualified custodian in Canada where you don't even have to have OnRamp holding a key if you don't want to. But what's happening here now is that there are XPubs being spun up that are creating that wallet in real time once you complete that, because the keys are already constructed offline, sharded, and we can talk about that if you'd like. But now when you onboard, you go to a slick, easy user interface. You can deposit Bitcoin. It looks like almost any other dashboard or financial service platform. But the real like magic sauce is when you can set up your inheritance. So no more like having to worry about it's a termination on death certificate. You can add different people. So God forbid you get hit by a bus, it's similar to your house or your bank account, like your wife knows where to go to. This is a big driver for a lot of our clients because as the wealth appreciates, none of our spouses really want anything to do with this thing. It's like, have fun with your Bitcoins. I hope it works out, And so that's a big component. But then where I mentioned the magic, and I truly mean it, is when I first started doing this for my own wealth and testing it out, is you go through video verification, and we can obviously talk about other processes in 3FA around AI, because I know that always comes up and we're prepared for that. But you go through your video verification with an operations specialist. You make sure you're not under duress and all the things that it's you. One thing I'll call out ahead of time locks is like just legal time locks, where some of our clients, specifically in Europe and Latin America, just ask for 7-day holds before the second signature because of the threat of violence. So that's where it ties into like humans and machines are going to talk to each other a lot longer than people expect. And you kind of want that. You want to live in a world where you still have trusted parties and partners. But then the real magic is you go now to an independent party, which is BitGo, and you're booking that video verification, and they're another person in a different location, an independent third party. And this is where the game theory kicks in because they have $100 billion in assets. If they screw up once, the market knows and they lose money. People leave, their reputation's at stake. And that's where I think this is so transformative and people don't grok is you're mixing the game theory along that makes Bitcoin also work from a decentralized perspective. And so whether it's 305, 507s, this is where I see the market going. And even if somebody rugs, they're rugging themselves. They're not rugging you. And that's what keeps the system honest. And so anyway, they sign their key and then the transaction's broadcasted.
And so just to make sure I've got walking through my understanding correctly there, in this example, let's say the customer onboards with Onramp. They are either buying the coins through you or they're depositing some coins into an Onramp vault, multi-institution custody. Actually, what's going on in the background is, let's say it's a 2 of 3 multisig, BitGo and CoinCover and Onramp can be 2 of 3 in that multisig quorum or the what's the I guess the technical term is threshold multisig for 2 of 3, and then actually underlying each of those key holders is their own sharded system and their own set of processes that the end customer has to go to and go through in terms of video verification and etc. Verifying that they truly want to do that transfer. But at the same time, you also have other policies that you can leverage on top of that. So only send out 10% of the coins per day or whatever. After a large threshold, you've got like a 1 week timeout before you can do the second signature, that kind of thing.
Yeah, I'm so glad you brought that up because that's a big thing that I think like our major clients today are coming from collaborative custody because they get already the 2 of 3 model. And the problem with it, it's a great thing, but the problem with it is we've historically associated private key generation with a hardware device, which is a 1-to-1 relationship, right? You have a seed phrase, hardware device develops a 12-word seed phrase. And so you have one or the other, and they're both central points of failure. If somebody captures one, you're kind of out of the game. Where in institutional grade key generation, it's never like a 1-to-1 relationship. So you're creating a private key in an offline air-gapped environment. And then when you take off pieces of it, you're taking off shards. It can be a 3 of 5, 5 of 7. Those are secured with independent individuals and independent vaults with independent security systems. And there's controls between that and then the video in between, just similar to financial controls. And so that was a big gap early on. People thought me and Mike Belshi could just call each other and like move money. And it just doesn't work like that because you can't go to Brian Armstrong and take the 700 billion or whatever in crypto assets. There's natural policies. And then the other part you mentioned is we have a growing branch network in the US, and then we'll have it globally in the sense where you'll be able to just go into physical branches and then authenticate yourself when it comes to moving large amounts of assets, right? And in an era where all of our money's online, physical presence and interaction is going to matter even more than it exists today. And so you can imagine if you're gonna move all your money, you should probably be able to meet somebody and know that you don't have a gun pointed at the back of your head. So yeah, those are some of the other aspects from a security perspective.
Interesting. I'm curious if you see this as, I'm sure you've seen some of these videos of people who are, I mean, this is kind of topical because I saw some of this stuff come up again today, where, people are going to the bank and the bank is saying, hey, show me your source of wealth. Before you withdraw this money, tell me where you got it, show me your bank accounts, show me your invoices, show me whatever, show me your first few Bitcoin transactions, this kind of thing. Does this system kind of risk that same kind of outcome where the user thinks he's got control of his money, but now again, he has to go kind of pass all these, AML questions?
Yeah, it's a great question. So at the end of the day, what makes the system really nice is the client, at least as the way it's constructed today, and will be in the future, because it all goes back to like, what's the best product? What's the best game theory to protect ourselves? Again, I come from the hardcore camp. Like I've gone through all the self custody, so I had to think about this for myself, and I use it. And each key holder is an agent of the individual. So think about it. The mental model is like pretend like CoinCover or Onramp is securing your key in an institutionally graded and sharded way and works at your direction. And so at the second they do not do what you ask them to do, and the market finds out, unless there's a logical reason to do that, that it kind of benefits everyone else or is in tune with what they ask, then you naturally are going to lose your clientele. And so that ties into like we have keys being set up globally, and that really ties into, what happens if the government says, US government says you owe taxes, right? And OnRamp, you're a US based company, do not sign their transaction. We would have to adhere to that. I don't want to I have kids, I don't want to end up in jail. But the reality is each other independent would have to honor that notion in the different jurisdictions. But also, this is what's kicker, is these are all separately managed on-chain wallets. So it's not like coordinated governments can, you start to pull it together and we can talk through it, but it's like you're only going after one wallet. It's how we were able to get $100 million Lloyd's of London policy wrapped around this at no incremental cost to our clients, because they've already underwritten all the institutions, because they already, are their insurance providers for Tetra, CoinCover, BitGo. They had to work through OnRamp's custody. But the point being is now you get the best of both worlds, because it's not a omnibus wallet where everyone knows, if Coinbase goes down, nobody's being made whole. Here, if there's an incident, it's at the segregated wallet level. And so it keeps some of the system honest. But I do hear you in the sense that if you're a regulated entity and you have to adhere to certain, permissions, and you onboard and you go deposit $1 billion, and somebody has questions like, well, there's going to be a problem, but that's kind of the beauty. The other key holders would work on your behalf to move the assets, depending on where they're at, depending on if they've gotten, notification from the government.
Back to the show in a moment. This show brought to you by CoinKite.com, the creators of the best Bitcoin hardware security devices, such as the Cold Card Mark IV and the new Cold Card Q. Now, we use Bitcoin hardware security devices to keep our keys offline, our private keys offline. Now, the way these work is you can do that setup, write down your 12 or 24 words on the seed word cards, and keep that secure. Now, you can use this device to interact with the Bitcoin network using software such as Sparrow Wallet, Electrum, or Vector Desktop, or Nunchuck as a few examples. Now, you have a range of security features that you can use with these devices, such as passphrases. You can use seed XOR, or my favorite is multi-signature. Now, if you're starting in a basic way, just start with the device and the USB-C cable, plug it directly to the computer and use it that way, and then later improve your setup. But I believe these devices are great at helping secure your coins, especially as you start to migrate up into multi-signature security. But don't be disheartened or don't be scared away. They are accessible, and I think you actually do learn about Bitcoin in the process. So to get yours, go to coinkite.com, use code Livera to get a discount on your cold card. This episode brought to you by Galloy. They are building banking software for the Bitcoin age. So if you are with a bank, a fintech, or a startup looking to offer some kind of Bitcoin product, whether that is a Bitcoin collateralized loan, deposit accounts, or payments, Galloy can help you. Their latest product is called Lana. It is a loans management platform, and you can use this to come to market quickly and offer a loans or Bitcoin collateralized lending product for your customers. Now, Galloy have a lot of experience in the space. They started with Blink Wallet in 2020, and they've since grown this to become a community favorite over time. And so they have a lot of experience making things work in a secure, reliable, and scalable way. So if you need assistance coming to market quickly with a Bitcoin banking product, such as lending or deposits or payments, talk to the team at Galloy. You can email them. The email is biz@galloy.io, or go to the website galloy.io. And now back to the show. Of course, depending on the situation. And but yeah, as we said, there's this spectrum, and every listener has to decide for themselves how hardcore, self-custody maxi are you going to go. And even then, you might have like a fraction approach. You might say, look, I'm going to keep most of my stack in my personal multisig, but I'm going to keep a small amount in this kind of thing, that kind of setup. It could make sense for an inheritance or some kind of just, in case you screw up kind of amount.
Can I share?
Oh, yeah,
Can I share
on.
one thing on that? Because I think you'll appreciate this. Is this really, in my mind, is helps the market structure security and is air cover for everyone else. So when you think about single sig custody and then multi-sig came about, and now we can claim we have multi-sig even if it was single sig.
Right.
When we see all these kidnappings and bad actors happening, the way I look at that is it's a sign of broken market structure, meaning that we haven't actually figured out custody. Because if you take a step back and look at, nobody kidnaps Jeff Bezos or billionaires or multimillionaires for their equity portfolio. Think about the amount of controls to liquidate the position in the publicly traded setup, go through the financial system and put it in a duffel bag. You're caught by then. But in Bitcoin, people know that we have pretty relatively quick access. So by the notion of putting in controls for a certain amount of wealth or this existing, others can basically lean on that and say it. So it doesn't have to even be something that's used, but it has to be regarded within as the market grows and
Right, it
more
has to be
bad
credible.
actors and credible that this exists. So then it's like, well, if I go rob my Bitcoin doesn't sit in my house. Don't take my kid. I can't do it. I have to go to the government or the police. And so it just changes the dynamic, which it's going to take a while for, but nobody's prepared for the amount of bad actors in the physical world once they find out that people are holding this digital bearer asset on their person. We're seeing glimpses of it now, but Bitcoin's only 100K. Just think about $250,000. People rob people's houses for a Rolex watch. What happens when 5, 10, $15 million? It's something that nobody's really prepared for, and that's kind of effectively why we like educate as a big component of our business.
Right, and I see that as, just in general, security needs to keep improving, and as you said, having some of these, let's say, policies or ways of restricting large flow of money instantly is going to be important overall to kind of help defend people's, or at least reduce the amount of theft and kidnappings and these kinds of things. Also, just out of curiosity, and I'm sure listeners will want to know, can you give an overview, like what are the rough costs for people to custody with you on the multi-institution custody stuff? And also, is there a threshold? Like, is it only worthwhile if you're above, a certain amount of BTC? Or, yeah, if you could just outline what are the costs and what are the thresholds here?
Yeah, one thing you mentioned about security is it's kind of non-trivial. We won't do it for everyone, but as our clientele grows and the amount of capital, you can imagine where you have a 304 and the client has to sign with the first key, or they have some sharded potential to come together. And then the policy from a legal perspective is the other key holders can't sign until the first key sign. There's a lot of interesting ways you can start to map this for larger pools. We're not for everyone to start. Like the idea, I look at Henry Ford and his model, and you've seen this with Tesla as well, where you have to like start at a market that will pay for the product. It was a key learning, and if we're going to talk about early riders, we could talk about it was the notion of we had to figure out how to make money, because at my previous firm we didn't make money because at the end of the day the responsibility is all on the individual, and so there's only so much capital you can make there. So these institutions are some of the best in the world, I would say the best in the world, and they don't get out of bed for free. So we have to be able to capitalize and then pay for them to, adhere to what they do. And so our minimum starts at $150 a month. So we've driven that price as close as we can to make it economical for either somebody that has anywhere between 100 to 250K or are looking to effectively invest in themselves because they know they're going to buy more they're going to increase their position, so they want a trusted place so they don't have to play hot potato. So that's where our custody starts, and then it kind of works up for, let's call it, up to $2 million. It's roughly $5,000 a year. Up to $5 million, it gets about $10,000 a year. Now, what I will share though, and this is part of what we just launched last week, is we have Onramp Trade that launched, and that's effectively like an on-ramp to on-ramp. So for our friends and family that we don't want to play hot potato and want best in class access to, trade, lowest cost fees there, access to what we're building, and then can easily migrate over into something like multi-institution. That's a viable solution where there's not like really a custody, like a cost like we're associating here. It's still some cost, but I see that as a huge opportunity because, as you're familiar with in this space, most people have played hot potato for the past 10 years. You go from X to Y to Z to self custody to collaborative, and you never have a place to provide peace of mind from the start all the way to like your family receiving it. And so that's kind of how we think about what we're building.
Gotcha. Okay. All right. Yeah. So I think we've kind of covered the custody aspects. I want to cover some of the other elements here as well. So on the early riders side, as I understand, this is like a Bitcoin fund where you are raising in Bitcoin, deploying in Bitcoin, and ideally going to make a profit in Bitcoin terms. So can you give us a bit of an overview there? And I guess the initial reaction most people will have is, hang on, you plan to outperform Bitcoin? Isn't that hard mode?
Yeah. Yeah, I mean, to be a little spicy, I would say like most people can't think about how they could outperform Bitcoin because Bitcoin would be the best idea that they come across. So they just look at it. And that's kind of what we see in the public traded, the treasury market space. It's like I think that the world forgot about how to deliver value to individuals. So there it's the last bastions of rent seeking. So you put a wrapper around Bitcoin and you get some fees versus actually delivering value. Where a lot of these concepts maybe come from that I don't think anybody listening to this would be like, well, this is insane, but it is different. It's definitely like heretical, a little different. Everything we talk about, the custody or Bitcoin denominated, is that my previous background was in the traditional tech world, for better or worse. So I was at the Googles of the world, and then I was actually with Adam Newman at WeWork in 2017, lighting money on fire with him unknowingly and then knowingly while I was reading Safe's book in the Bitcoin Standard. So it was a very formative time in my life to go through that journey. And for better or worse, in the tech world, historically, the best operators that exist on the planet are there. It's where everyone goes. And when I came into the Bitcoin space, I didn't see it. I didn't see it across building Bitcoin businesses. I helped set up some of the larger Bitcoin venture firms and didn't see it at that level. And so when I took a step back in 2022, it wasn't like a vision to go start a venture fund, even though I always knew I wanted to be in that space. But when we built OnRamp, I had just seen how liquidity killed all soundness in business unit economics and just the soundness of the business, the resiliency, whether it was in the traditional world or the Bitcoin world. I kind of joke and say most Bitcoin companies are fiat companies with a Bitcoin theme because they're still playing the VC game of how do I get the multiples and how do I grow at all costs, which now they're starting to recognize as a recipe for disaster because Bitcoin cycles are like accelerated business cycles. So everyone got told, even though they'll whitewash and say they did it, they hired a bunch of people in 21 and laid them all off, everyone in 22, because they told the VCs told them go run at all costs and go, try to like increase, all the numbers and stuff. And so to your point, like venture in general, if you go, and I was just a student of it for a long time, is you go back to the 60s and 70s and where it stemmed from was it was meant to be artisanal and very much craft based. It wasn't like not meant to be what it is become today. Fiat has basically driven that. As more capitals come in, it's put more academics in allocation and also just more capital out, and it effectively kind of again kills the businesses. And we all know the Ubers of the world and DoorDash is like they're kind of a product of zero interest rate policy. And so you tie that all the way through. What broke a lot of the soundness in these businesses is everyone's chasing the wrong underlying unit, as we know. So from the LP perspective, they have too many dollars. They're trying to, chase. Everyone knows you're a sucker if you're holding dollars. So you're figuring out you don't have the most discernment in is your GP or your allocator. The GP is always trying to either raise a larger fund or they're sitting on dollars because they know they're a sucker, including like if you're a Bitcoin VC, it's like what are you doing? You're sitting on the dollars, like your mandate's to invest. So you have a hammer and everything needs to look like a nail. So all you're doing all day long is looking at deals to invest in. And then on the builder side, the builder is the ultimate allocator, right? At the end of the day, like they're the ones that are having to deploy dollars to have a greater return. And so now they're getting told by everyone to run as fast as they can, go deploy the capital. Well, what happens when you take a step back from that and you actually put Bitcoin across the full spectrum? So whether it's us knowing our cost of capital is a return on Bitcoin, the GP being able to sit on an asset that's increasing in purchasing power. So not only they're more discerning, they're increasing the amount of equity they can own in business by its nature of Bitcoin's purchasing. And then the ultimate allocator, which is the entrepreneur, is sitting on the hardest asset we all know to man, and now looks at every decision point as, well, this is my cost of capital. And it's not to say you don't spend the money. It's just that you have to be very discerning in the realization of what you're doing and how do you affect your reality or your vision of your company. And so all this might sound theoretical, but the reason why we launched this is because this is how we built Onramp. So previously have seen all this liquidity, it scared the living crap out of me that I knew we had a big idea and a big opportunity in the market. And I was worried to death about letting it being ruined or corrupted by bringing in lots of capital. So I spent my own money on founding the business, my own Bitcoin. And what I stumbled on through that was like, holy crap. Like this is the most efficient way. When you think about leveraging AI, how you hire productively, there's just no shortage of anecdotes we can share that was like, oh my God, this is the future. Because at the end of the day, every rational actor is only going to invest if they believe they're going to get more Bitcoin. So that's one. But then the other side of that is every business is going to outcompete every other business, not because they have Bitcoin on their treasury. That's like second order. It's because they have baked into the ethos and philosophy of the business as building the most productive business because they're trying to chase more BTC via their own pocketbooks. So we go back to dividend structures. So I know I kind of rambled for a bit, but that walks you through like how we got here, and then we can talk about
I
any of the
see.
holes because people always have questions, and it's easy to kind of work through them on how it works or how we got there.
I see. And so I guess in summary, the basic idea is if you denominate in Bitcoin and you deploy in Bitcoin and the premise, let's say the founder, the person raising and so on, understands that premise, operates from that premise that he needs to be Bitcoin profitable, that changes the dynamic. That's kind of the broad idea I'm getting from you there. And also this idea of having a Bitcoin treasury as opposed to being too highly allocated to fiat. Would you say that's a fair summary, or what are the key pieces?
Yeah, I think the two big components is it all comes down to people. So if you give the wrong person the Bitcoin and the right person the dollars, the right person's still going to outperform the other individual, even if they have the wrong unit, because this comes down to the individual and the discernment. And then the thing that in my previous venture life, I got tired of sitting all day long in rooms with people that we shouldn't give our money to. Everyone claims they have access. Nobody has access because they're all looking at the same deals. And then talking to all the allocators, trying to convince them what Bitcoin was. So it was like half your day is just literally wasted. And I was like, well, that doesn't make any sense. And so the alternative to what we do is that we're not looking at like investing in everything. We're busy building a business. But when you're busy actually operating, that's the true definition of access because you get to spot all the gaps that actually exist in the market because you're literally in the middle of the market. And so that's really where we come up with some very fascinating things we're looking at is because it's just stuff rooted in not true venture, 9 out of 10 failing, because that doesn't make sense in a Bitcoin venture fund, but more in the things that have a natural market fit because the market's asking for it. And now there's execution risk and everything, including investing, but it's a little bit of a different model than you would think of like what's lightning in payments and how are we going to get there? And we're going to, deploy 25 Bitcoin and then have it go up in smoke.
I see, yeah. And so I guess the other difference I'm sort of getting as well as I was kind of looking through the deck as an example is maybe there's slightly more of a focus on, I guess, what's called the EIR, entrepreneur in residence, or kind of putting your own people in, kind of parachuting your own guys in because maybe they are already more knowledgeable about the Bitcoin aspect of it with maybe, as you said, the right person, the right mindset.
It's 100% right. It's one of the big learnings when I referenced earlier is historically in Bitcoin, and this isn't a fault on anyone, it's just innovation cycles. The people that are building or had been historically building in Bitcoin were the early adopters. And the early adopters, we all kind of know them like they may have a little couple things in their wires crossed and like what got them to get Bitcoin at $10. They may not be the best person to understand how to meet the market where they are, how to commercialize a product. The best example I have is like somebody that likes to cook doesn't necessarily mean they can go franchise out a big restaurant. And so the idea with OnRamp and also the things we invest in is we take people with like 10 plus years of professional experience that also deeply grok Bitcoin. So they can have this conversation, but they also are domain experts in their own space. Because what we found is we're not going to recreate the wheel for better or worse. We're just going to repurpose it. We're just going to slightly, and you can start to squint and see this with the bit bonds idea and even multi-institution, right? It's like there's still going to be trusted parties. We're not going to, just go off into, the future with not having anybody. How are we going to coordinate economic activity? But so that's a core component. And then we have this guild network, which is a blend between on-ramp private clients and then early riders, where we loop everyone into this application that is advisors, partners, founders, EIRs, and our network. Because I'm sure, as you know, there's no shortage of business professionals that deeply get what we're saying here and are kind of like dying inside because they're making their fiat mining and they have no way to express their view in the world. And they know they want to make the leap into it, but they're just not ready because there's only so many Bitcoin companies and definitely only a small fraction of them that they feel have a like longevity they'll want to be a part of. And so that's a big thing we see as our big moat is the guild network and people getting involved through that, because that goes across disciplines, right? Like Bitcoin's going to touch everything, not just money and financial services. And it's called early riders. Is I was talking to an advisor yesterday and he was referencing early riders came about because we had enough conversations with institutions that had no idea why we would want to do multi-institution custody. Is it kind of how we're either really crazy or onto something is because the hardcore Bitcoiners think we're nuts, and then the TradFi people think we're nuts. And so you're either really dumb, or you're actually onto something massive, because our mental models, it kind of breaks both of them. And so realizing that about Bitcoin and AI, it was this notion of holy crap, like the incumbents are not going to win this space. Like when it comes to when it comes to financial services, it's going to be the early riders. It's going to be the people that grok all of this are the first. And I was talking to an advisor to Onramp yesterday, and he referenced like, oh, the early riders is also like a symbolic from the religious text of like Joshua and Caleb going out and being the first ones out there to go like scout to pave the way for everyone else. And that's how I think of this. The white paper we produce is similar to multi-institution custody being out in the market. TBD on if we win or are able to execute. I think we will be, but it's really that this notion that this is a new way for capital to form and will be a standard in the future was the important thing to get out, because I see this as the base level for as we go and like grow the economy.
Another big topic now is the whole, and I'm sure you'll have insight on this, is the whole Treasury company thing, right? Because obviously this is a big topic now. People are sort of saying, 2017 was kind of the shitcoin ICOs, 2021 was DeFi NFT. Maybe this cycle is going to be the cycle of Bitcoin treasury companies and, mNAV and these conversations. I know in your business and businesses, maybe some of them are involved in servicing some of these Bitcoin treasury companies. I'm curious your view. Do you think, and I guess I had a conversation recently with VJ Boy Party and we were talking about that, and he was kind of saying, look, maybe mNAV is the new GBTC premium, is that the new thing this cycle? I am curious to get your view there. Is it a sustainable thing? Is it not? What do you think?
I definitely don't think it's sustainable. I try not to talk about this, but I keep finding myself, and I don't have a filter. So like it gets a little spicy in the sense that I will caveat and say that everything is good for Bitcoin. Everything, including this. I don't think this is good for individuals. I don't think it's good for where we're headed, but at the same time, it's good for Bitcoin because number go up is probably the best barometer from awareness. And so this will drive prices higher. Now, at the same time, there's multiple levels to look at this from I don't even know if it's metaphysical, but like at the core idea, a lot of people were grown up that if it's too good to be true, it's too good to be true. Money doesn't grow on trees. And so the way I think about it, luckily I had this conversation yesterday, so I'm a little bit better prepared to articulate it, is there's a notion that's happening today that if you accumulate a bunch of Bitcoin, you are going to be a rainmaker or kingmaker in the future because you're going to be able to allocate it better. And that's kind of one of the plays for some of these corporate strategies. There's different reasons why they're doing it. The thing that's missing is, again, if these individuals running these only have 2 to 5% of their personal net worth, if not less than that, in Bitcoin, well, they're going to lose all the Bitcoin in the same way that somebody that wins the lotto ticket, like they didn't earn the capital. There was no proof of work there. So again, can't tell you how it'll, deleverage and what will happen, but it's just naturally inorganic to take a decentralized asset and then start to centralize it. It goes back to where the on-ramp and multi-institution custody comes about. So there's a lot of just different things that, again, to your point, where there's smoke, there's fire. And again, goes back to like ICOs. People can wrap their heads around speculative bets. So there's like a confluence of different things happening with the corporate treasury. Some are, can I get my next 100 bagger? Others are taking advantage of the naivete that people don't know how to get spot exposure to the underlying. Again, which is why I think multi-institution is so important, because now, as the market knows, you can click a button, get access to spot Bitcoin, and always take delivery of it. That's, I think we'd agree, better than getting some proxy exposure to an equity that's inside money, by the way. That's the thing that like everyone's going to get rugged on, is where we're going, for better or worse, is outside money wins. Like gold and Bitcoin are going to be labeled and understood by the market as money, and everything else is credit. And everyone else between now and then is going to have to learn the hard way of the counterparty risk and the associated. You talked about getting cut off from your multi-institution. Imagine getting cut off from your brokerage account because you tweeted one wrong thing. Like nobody really groks this. And so, yeah, I really don't like it, but it is what it is, and the market's going to do it. So,
Yeah, I mean, I've mixed feelings on it too. I personally do believe. I'm curious. So here's how I see it, and I'm curious to get your reaction. My impression of this is Bitcoin, just like Jesse or Croesus talks about, there's this 1,000 trillion, market out there if you add up equity and bonds and property and, currency and all these things. And Bitcoin is only 2 trillion of that. So, clearly we're early. So I think there is some sense in which an mNAV can make sense for a conservative, prudently run Bitcoin treasury companies. But will there be irresponsible ones who, get delevered and get wrecked at the top of the next cycle, at the bottom of the next cycle, the bottom of the bear or whatever? That's certainly possible too. But the way I'm seeing it is, I believe the responsibly run ones can sustain an mNAV greater than 1 for a few reasons. I think there's a fiat arbitrage going on here, right? Because they can access the public debt and equity markets that we as individuals cannot. So I think there will just be kind of a bit of a sustainable medium-term advantage, but maybe that advantage kind of comes back down towards like an mNAV of 1 as we approach hyper-Bitcoinization, right? Because maybe that fiat regulatory arbitrage closes down, and maybe by then they'll morph into banks or insurance companies or something like that. But that's kind of my high-level view. I'm curious, do you agree or disagree, or how do you see it?
yeah, I mean, so I kind of disagree in the sense that most of these people, if we talked about like custody and what we're talking about today, don't get Bitcoin. So it's giving them a lot of credit to say that they're going to get this asset and be able to steward it in an appropriate way. And ultimately, Marty had a good tweet yesterday, and it ties into, I see productive businesses is what's interesting when they start accreting Bitcoin. The funny part is they're not actually incentivized. It's a real weird paradox. It's kind of the more speculative companies incentivized to do this
Right, the
versus
zombie ones who came into it.
versus Nvidia or Microsoft that would raise flags because it's like, well, why you're doing this strategy versus doing X, Y, or Z. But that paradox plays into why would mNAV be above 1? And then what's the financial engineering around it? And then ultimately, how far do people have to go on the risk curve? How long is that sustainable? And then when that delevers, because that's another big aspect of this is like the volatility that we understand with Bitcoin, we can weather it because we have deep conviction in this asset. Well, it's objectively going to be more volatile than Bitcoin, and nobody has that conviction and confidence. And the sad part is, again, I think this is why I hate it, is it proliferates or like attaches to the naivete of the individual that the 60/40 exists, right? So it's a lot easier to take 20% of your equities into one of these products versus putting it into Bitcoin, because Bitcoin, most people don't know how to bucket. And so the last thing I'll share is I think it's a lot of BS that people will say all these capital pools don't know how to get Bitcoin. Like anybody on the planet Earth can figure out how to get Bitcoin. And the easy example of this, in the same way when an individual buys on Cash App or whatever, and then ready to go buy material size, well, you figure it out, right? Not only do you figure out where to buy, but you figure out how to custody it and make sure you hold it. In the same way, when these institutions, sure, I can buy, they're paying an arbitrage or getting small exposure, but they're eventually going to do the work and wonder why Bitcoin is appreciating, or this asset is appreciating on proxy with Bitcoin. Well, it's the only logical thing to do, to go take the underlying asset, because you have to worry about the counterparty risk of the execution of the management team and the underlying. It's just all like the whole thing that we're trying to get away from being kind of like galvanized or lauded, because it pumps our bags. And that's why you get, if this was anything else, if this was altcoins and we just said, you're going to put an altcoin wrapped around this and trade it, everyone would be up in arms. But because it's public equities, which are effectively altcoins because they're just traded on vibes, right, at this point. So anyway.
Yeah, interesting. I think for me, it's more like there is a regulatory window here, right? Because there's indexes and there's just passive flow going into those. I think I would make a similar analogy to meeting people where they're at, right? People could make the same argument that, a bunch of us are being hardcores who want our everything in our cold card or our multisig, but there'll be all these people who, they want a ticker to buy on their stock broking app or whatever. And I think that is going to be where a lot of people kind of get a first exposure to things. And then hopefully they come down the rabbit hole and that's where they learn about, okay, self-custody and all these things. But I think we're just fundamentally early in this journey. And so that's why it's going to look kind of crazy. And of course there'll be bull and bear. I think there'll be cycles to come, but I think the well-managed ones will actually survive, just like MicroStrategy survived through that recent bear. I think it'll be a similar thing.
But the caveat to that is you can make the same case about FTX and BlockFi. Like, not only did their bankruptcy help print a lot of Bitcoiners, but the market price that they juiced it up, but it didn't make it good for the individual. So that's where I talked in the very beginning. It's everything's good for Bitcoin, but at the end of the day, it's like, do we have to participate in it? Because I think you can make the case you just shared on the ETF side, because it's just not the best exposure, but it's buying Bitcoin versus people are inherently, we know gambling apps are at all-time highs, and all the amount of capital via the nihilistic view of the world is they're going out and chasing these like tickers by proxy Bitcoin. And sure, it's like some people are going to learn about Bitcoin, but yes, it's good for Bitcoin, but B, do we have to like participate, do it? And that's where like the other side of it is like launching them, because you see these talks and they kind of like go up and they just completely crash, and TBD like where they end up as like exit liquidity. So it's like, it's the most beautiful version in my mind of the affinity scam on Bitcoin, because everyone is like somehow okay with it in the same way everyone's okay. Like the case you made a second ago was the same you can make about EOS and those tokens that like pumped. Some people learned about Bitcoin and got their first exposure. My first was like, whatever. But you see where I'm going with it. Like the same case can be made that it helps people get into Bitcoin, but is it good for the vast majority of individuals versus other proxy exposures that are just like more direct, just Bitcoin? It's not a ticker that like has, underlying.
Interesting. I think of it slightly differently, though, because I think the case of EOS and other things, they support a competing network effect. Whereas if you're buying Bitcoin treasury companies, you're supporting the Bitcoin network effect. So in that way, it's a bit different. But I grant you, absolutely, there will be people who, just like in Bitcoin cycles, there'll be people who buy the top and panic sell the bottom, just like in Bitcoin. And I think it will be sort of like a earlier, like it'll be kind of like the experience of Bitcoin in earlier years. I think James Check made that analogy where he was saying it's kind of like if you buy MSTR now, it's kind of like buying Bitcoin in 2013. You're going to have that kind of volatility experience because it is levered Bitcoin. And so I think of it as, well, that's going to be the way. I guess I still am structurally positive on these things, but I accept that, yeah, for sure, there'll be people who buy the top and so on.
And I'll share one other thing that I think we're discounting is more than likely in 12 months, there's going to be XRP, Solana, not only ETFs, but publicly
I think
traded
there already
companies.
is one. I think there already is one, yeah.
Yeah, so there's going to
But
be
maybe
more,
there'll be
and
many more, yeah.
there's going to be many more that people play this, and then what you're sharing today won't be looked at in a vacuum because it won't be just Bitcoin. Now the rest of the market is going to look at what's the next treasury that has crypto in their corporate treasury, because I think one just went public with Trump coin. They're raising like 300 million. That's going to be Trump and BTC. And so now you're going to go back to be like, oh wait, you should have just bought the Bitcoin. Like that's probably the best thing for everyone, because the other side of this is when the market delevers, because I think we'd all agree that the liquidity is going to come in like crazy this cycle. When the market delevers, they're probably going to blame Bitcoin again in the same way they blame Bitcoin and FTX. And everyone's going to be like, oh, maybe
Of
these people
course.
shouldn't do it. And so that's just another part of the like byproduct around how I
Yeah.
feel about it.
I mean, I'm totally with you that we're going to, this is not the final cycle. And so we're going to have, bull and bear, and there'll be different reasons and rhymes, about them. And, so be it. So anyway, I guess we've both shared our view on that. Let's talk a little bit about Bitcoin in MENA. I live here in Dubai in UAE. So obviously, want to hear your thoughts on what you're doing in the Middle East region.
Yeah, appreciate you bringing that up. So I personally love the region. I think it's prime for Bitcoin adoption, and sadly is like a couple steps behind from a crypto, and you're in the middle of it. So I'd love to hear you share your thoughts. But it's like the way that this all started was Laura, and it's funny, she pinged me here, who from Bitcoin Oasis, had
Yeah.
reached out via multiple networks and was like, hey, we'd love for you to come out. They were trying to put on a conference. And I think this was like 2 years ago at this point, and had actually never been out there. And they were referencing, it was funny because she was like, well, when you come out here, you got to shake people's hands and you got to look them in the eye and all this stuff. And I was just like, I told her, like, this sounds a lot like Texas because we had built our previous business in Texas similar to this one. And it's like, it sounds like Texas, except for they just wear different hats. Like that's just how you do business. You shake people's hand, and kind of like build relationships. You're not basically swooping in because the thing that everyone goes is they go swoop in to land for 3 days, thinks they're going to raise money. And it's just not how it works in the GCC in general. And so we went out there and just absolutely loved it. But the thing that I took away from it was, holy crap, like these are the most sophisticated crypto people on the planet Earth. The level of things that they're doing there, it's like I don't even know how to wrap my head around. And so they're leading on all this kind of bridge and the integrations with banks. And you've seen it, and there's Token 2049, but it's also the most unsophisticated place in the world on Bitcoin. It's like, in my view, it's like a Bitcoin desert in the desert. And in the West, we've got all these products and Bitcoin only exchanges and custody. And we left there and was like, oh my God. And we know that like multi-institution has a place in the world. And in our view, it has a big place and is a byproduct of all the learnings. It's like, well, what if we can help the GCC like bypass a lot of this? And we heard the stories about, again, sheiks holding 20 to 100,000 BTC on these little ledgers sitting in, safety deposit box in central banks. And so that's really how Onramp MENA, it's a complete sister company. It's led by Ralph Gibran, who fantastic guy. He moved his family from Canada, originally from Lebanon. And we're super excited. We're getting licensed by one of the central banks in the region in the process of that, which is exciting. And the core idea is just to build a Bitcoin only firm and really build that education for all these different institutions, family offices, and individuals that have all this crypto noise being thrown at them.
Awesome. And so, yeah, as you said, I think there's definitely a lot of opportunities in the region. It's one theme that I notice is in the GCC, the Gulf Cooperation Council, there is a lot of focus on diversifying from oil. Now, the UAE has been relatively good on that, but maybe some of the other parties or some of the other states in the GCC, like Saudi and other countries, they're also thinking about this, but not as advanced on the journey. And obviously, Bitcoin is a perfect fit there. So I think that's a big thing. And certainly, yeah, there's a lot of role for education, for people to understand, Bitcoin versus crypto and things like this. Of course, there are events out here, right? Bitcoin Oasis, run by Lara and the team, as well as Bitcoin MENA, which was organized by the Bitcoin Magazine, the Bitcoin conference guys. So that was in Abu Dhabi last year, and I believe it'll be on again this year, December. So, there are some of these events, but there's also a lot of crypto events, and there's also a lot of crypto people in general. So that's kind of one thing you have to just grapple with when you're in this region. But overall, I think it's definitely a lot of potential here. Generally a business-friendly environment, low taxes, this kind of thing. But obviously has its own nuances that you have to appreciate when you're here.
Yeah, I think the thing you keyed in on is it's a commodity-based culture. Like they understand, the amount of, their resource is the oil. And so what I saw in Texas is you naturally have a quicker path into, like, very similar to us as on the Bitcoin side, know how like athletes and the proof of work actors in the economy get Bitcoin because they feel their labor kind of being stolen from them. In the same way that the commodity rich countries in areas of the world naturally get Bitcoin because their first version is, well, what's the cost to actually produce a Bitcoin? I can sell that for fiat. But then as the price goes up, it's just like an easy gap to be like, well, what is the thing? And so I think that, and we're actually going to have Matthew Pines on a pod in 30 minutes for OnRamp. And it's something I want to talk to him about because he's a big proponent of this intersection of like the geopolitical function of energy, AI, and also Bitcoin, and how they're all kind of like starting to converge. And yesterday was the big meeting in Saudi. And so I see these things just accelerating, right? And like an example is the off-grid mining. We all know Bitcoin's like this canary in the coal mine, where I think of off-grid mining as the canary in the coal mine for cheap energy, right? It was first the hardcore off-grid miners that went and found low cost energy. And then now we've seen the AI compute companies starting to go buy them. So they're like almost like the scouts out in the market. And so that's kind of like where the mining has started. But now you have these AI data centers that are becoming very valuable. And so there's just a lot of confluence that I think the Middle East is going to intersect with Bitcoin. And then there's obviously, it's the money of their religion when you think about the soundness of they don't participate in usury, and there's 2.1 billion Muslims on the planet Earth that haven't really had a good form of money. I don't know if you had Harris on before, but he's a
I
fantastic
have, yeah.
proponent. Oh, nice. Yeah, he's a fantastic proponent, advisor to Onramp MENA. And it's sad because when you think about it, it's the solution they've been looking for, but it's so hard to wrap your head around understanding Bitcoin. And then also the powers that be in that world aren't really incentivized to explain why Bitcoin is valuable versus Sharia compliant is just like regular TradFi with a like nice, marketing spin on it.
Yeah, and I think it's, to be fair, even at the recent Bitcoin Oasis, both Harris Irfan and Muwaya Tucker were kind of explaining as well, kind of, that kind of aspect of Bitcoin as anti-riba money. But again, it comes to it's the actions. And so to be fair, they would be, let's say, they would probably be against, let's say, these Bitcoin treasury companies, again, because they would see that as, they could see elements of that are, based on leverage, based on kind of making money from money, as opposed to like an equity form of investment into a company and risk sharing. I think that's probably the concept that I've heard them speak about. Of course, I'm not an expert in this, but just from what I've heard of how they explain it. So yeah, certainly interesting region, and we'll see what happens there. So yeah, I guess we've kind of covered a bunch of different things, but any kind of closing thought or anything you want listeners to take away before we let you go?
No, I think this was a great discussion. I appreciate you kind of weaving through it and challenging or talking about some of the topics that are a little hairier in the space that don't get talked about. If anybody wants to learn more, talk with us. I think the big thing I was hesitant like pre 2020 March. I didn't really talk heavily about Bitcoin, specifically with friends and family. And then it was COVID and the amount of printing that it's like, hey, what are we doing here if we silence ourselves? And so then for 4 years, we've been building OnRamp naturally coming from the camp that we sit in and building self-custody products have been hesitant to really be too loud about the risk for our friends and family, including ourselves, because it's just like it's going to be looked at as like, oh, it's just self-serving talking his book. But this is increasing, and now I kind of feel responsibility to break down that as society starts to get a little rougher as we go through a rough patch with the crumbling of kind of like the base money, bad actors are going to increasingly know that we hold this asset and all the data is out there. When you think about, it came out Coinbase users were selling, employees were selling the client's data, like via chain analysis and all these other tools, you can put into an AI model and probably figure out honestly how much a lot of people you wouldn't expect Bitcoin they hold directionally. And so when bad actors start to realize that in the physical world, we're just going to all start to now be a little bit more apprehensive, whether it's sell positions or families. There's a lot of things coming that I don't think we're prepared for. And so I would just encourage everyone to think about that and be prepared for it because $250,000 Bitcoin will be here sooner than we know it. And then with that comes an insane amount of responsibility that I don't think we were prepared for at $2,500 Bitcoin.
Yeah, I think it's a fair warning. A lot of people have to think about the security aspects and maybe the privacy element of it also. So yeah, listeners, check it out. And Michael, thank you for joining me.
Yeah, thanks, Stefan. Appreciate it.